Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
542,491,528. That is the exact number we need to start with today. On Wednesday, February 18th, 2026, over 500 million shares of Rackspace Technology changed hands in a single trading session.
Which is frankly absolutely insane, considering the company only has about 243 million shares outstanding.
Right, exactly. The entire float turned over more than twice in, 6.5 hours? We saw the stock open at $1 flat and close at $1.37. I mean, that is a single-day move of over 200% from the previous close of 42 cents. By Friday, February 20th, we hit an intraday high of $2.08. We are looking at a stock that was effectively left for dead, languishing in the 40-cent range, suddenly waking up with violent historic momentum.
Violent is definitely the right word, but let us be very careful about calling it momentum. You look at that and see a fundamental awakening. I see a textbook market microstructure event. We really have to be precise here. Before this news hit the wire, short interest in Rackspace was climbing over 27%. When a catalyst hits a stock with that kind of extreme positioning, you don't get price discovery, you get a mechanical squeeze. That 500 million share volume, that is just the sound of shorts rushing for the exit, forcing a liquidation loop. It is not necessarily long-term investors buying into a 10-year thesis. Plus, look at the technical damage that is still there. Even at $1.68, we are down 50% from the 52-week high. The relative strength index is screaming that it is an overbought territory.
While I concede the squeeze mechanics definitely provided the fuel, but the spark was fundamental. You simply cannot ignore the catalyst here, which was the February 18th announcement of the strategic partnership with Palantir Technologies. And this brings us to the core question we are analyzing today. The market has been treating Rackspace like a distressed legacy hosting company, essentially pricing it for bankruptcy. But if this partnership is real, if Rackspace is successfully pivoting to become a sovereign AI provider, then we aren't looking at a squeeze. We are looking at a total repricing of the asset. So the debate is this: is Rackspace a debt-laden trap, or is it a coiled spring that could reasonably see a 5x increase in value over the next decade?
That is exactly the right question to ask, but the answer isn't going to be found in a glowing press release. It is buried in the balance sheet.
Fair enough. Let me lay out the thesis for the transformation first. My perspective is that the market is finally waking up to a massive strategic pivot that has been hiding in plain sight. Rackspace is transitioning away from low-margin managed hosting, which we all know is a commoditized, brutal business, and moving into high-value sovereign AI and specialized infrastructure. And the evidence is tangible. The Palantir partnership targets highly regulated verticals. We're talking healthcare, finance, defense.
Right, the sectors with the most red tape.
Exactly. These are sectors where you simply cannot just throw your sensitive data onto a public cloud due to regulatory hurdles. From a valuation standpoint, look at the massive disconnect. The stock trades at a distressed price-to-sales ratio of 0.2. The industry average for IT services is 2.1. If the market simply re-rates this company to a 1.0 sales multiple, which is still a 50% discount to the broader industry, we are looking at massive upside. We are talking about a company generating billions in revenue being priced like it is going out of business next week. I represent the side that sees this as a fundamental turnaround story.
And I represent the perspective that it might actually go out of business. If not next week, then certainly before this massive pivot ever pays off. You are looking at the theoretical reward. I am looking at the existential risk. My argument is that Rackspace equity is currently functioning as an out-of-the-money call option on a company with a completely unsustainable capital structure. This rally last week was a liquidity event, not a fundamental shift in the company's health. We are looking at $2.76 billion in long-term debt against a market cap that even after this historic rally is only around $408 million.
But
Let me just finish the math on this. The projected debt-to-EBITDA ratio for 2025 is between 7.8 and 8.6.
That is the kind of leverage that absolutely suffocates growth. Interest expenses are eating their operating margins alive. You are betting on them competing with AWS and Azure in the AI space, but they are fighting that war with one hand tied behind their back by their creditors.
I think you are focusing too much on the rearview mirror. While the company is clearly looking at the road ahead, let us actually dig into this Palantir pivot, because I don't think the broader market fully grasps what sovereign AI actually implies in practice.
Define it then. Because to a lot of analysts, sovereign AI just sounds like a convenient buzzword salad designed to generate exactly this kind of stock pop.
It is much more than a buzzword. Sovereign AI isn't just about putting artificial intelligence in the cloud. It is fundamentally about data residency and data control. The deal they announced integrates Palantir's Foundry and their artificial intelligence platform directly into Rackspace's private cloud, specifically their UK sovereign data centers. Here is the critical distinction. If you are the UK government or a massive Swiss bank or a defense contractor, you cannot legally upload your highly sensitive data sets to a public server farm sitting in Virginia or Frankfurt. You need strict data sovereignty. The data must physically reside within specific national borders and be managed by cleared nationals of that specific country.
I acknowledge the compliance aspect.
It is their entire moat. On January 14, 2026, Rackspace achieved the VMware Sovereign Cloud certification. They aren't just selling empty server space anymore. They are selling a highly governed operating model that the hyperscalers genuinely struggle to offer without introducing massive complexity. The Palantir integration reduces AI deployment timelines for these secure clients from years down to weeks.
I understand the theoretical moat you are outlining, and I concede the VMware certification is a very nice badge to have, but I strongly question the execution risk here. You are talking about transitioning to a high-touch, consulting-heavy model. In their announcement, they noted they have 30 Palantir-trained engineers right now, with a pledge to scale that up to 250 in the next 12 months. Do you have any idea how expensive high-end AI engineering talent is right now?
It is a premium, certainly.
It is the most expensive labor in the entire global market. Where is a company burdened with $2.7 billion in debt going to find the free cash flow to acquire and retain that specific talent?
They repurpose. They are actively shifting resources away from legacy support roles and into this new vertical. It is an internal transformation. It is not just a blind hiring spree on the open market.
Shifting corporate culture is exponentially harder than shifting cash. You cannot just take a legacy server administrator and turn them into a Palantir Foundry architect over a weekend training course. That is a massive structural skills gap. And you mentioned the hyperscalers earlier. AWS, Microsoft Azure, Google. You talk about sovereign AI as if they are just ignoring it. They aren't. AWS is actively launching sovereign regions across Europe right now. Microsoft has their Cloud for Sovereignty initiative. They have effectively infinite capital to throw at this exact problem. If AWS decides they truly want that UK sovereign workload, Rackspace's so-called advantage commoditizes very, very quickly. Rackspace is a speedboat, trying to outmaneuver nuclear aircraft carriers.
But the speedboat is highly specialized. The hyperscalers are, by definition, generalists. They build massive, standardized regions that rely on economies of scale. Rackspace is offering a bespoke private cloud environment. And look at the leadership signals they are sending. On January 27th, they appointed Joseph Vito as Senior Vice President of Strategic Alliance Partnerships. Where did he come from? He came from AWS and UBS. This clearly signals they are bringing in executives who understand exactly how to bridge the gap between hyperscale technology and banking-grade compliance. They are building a boutique consultancy wrapper around the infrastructure. It is a totally different business model than just selling raw compute power.
Or it signals ongoing leadership churn. Trying to overhaul a company culture from managed hosting, which is basically just keeping the lights on for legacy systems, to high-value AI consulting takes years to execute properly. Rackspace does not have years. They have a ticking clock on their debt. Which brings us to the harsh reality of the balance sheet. This is the elephant in the room that we simply cannot ignore in this debate.
I suspect this is where our perspectives will diverge the most sharply. You see the debt as a coffin. I see it as a manageable load, provided the pivot continues to work.
It is not just the sheer amount of debt. It is the cost of servicing it. We really have to do a deep dive here because this is the gravity that will inevitably hold the stock down. Yes, they did a refinancing in 2024. The bulls cheered because it pushed the maturity wall out to 2028. But all that maneuver really did was buy them time at a very, very expensive price point. Look at the interest rates they agreed to. The first lien, first out term loan is pegged to SOFR, the secured overnight financing rate, plus 625 basis points. In the current rate environment, that is incredibly expensive money. Their unsecured notes are sitting at 5.375%. That floating rate debt is toxic.
It is a heavy burden, I agree.
We have credit analysts explicitly warning of high bankruptcy probability for a reason. If they stumble even slightly on the execution of this Palantir deal, the entire capital structure collapses. We saw Q3 2025 GAAP revenue decline 1% year over year to $671 million. They posted a net loss of $67 million in that quarter alone. You simply cannot service $2.7 billion in debt while posting net losses forever. The math does not work.
Hold on. We need to be precise. You are looking at GAAP net losses, which include significant non-cash charges like depreciation and amortization. If we are debating actual solvency, we need to talk about cash. In Q3 2025, Rackspace generated $71 million in operating cash flow. On a trailing 12-month basis, that is $146 million. They are not bleeding cash operationally. They are paying their bills.
Barely. And paying the utility bill is not a growth thesis.
But barely is enough to support the deleveraging thesis. This is where the math gets incredibly fascinating for the equity holder, and I want to walk through this slowly so the implication is clear. The enterprise value, or EV, of the company is roughly $3.55 billion. Right now, the vast majority of that value belongs to the debt holders. But if the enterprise value stays completely flat, just flat, and they use that operating cash flow to pay down the principal on the debt, the equity value must logically rise.
In a vacuum, yes.
Think of it like a house worth $1 million, but you have a $900,000 mortgage. Your equity is only $100,000. If you pay off another $100,000 of that mortgage, your equity doubles to $200,000, even if the actual price of the house doesn't change a single cent. If Rackspace simply reduces their debt by $1.5 billion over a decade, you could see the equity 5x just from the mechanical act of deleveraging, without the business theoretically becoming any more valuable to the broader market.
That is an incredibly dangerous assumption to make. You are assuming the value of the house, the enterprise value, doesn't drop. If the business shrinks because they lose their legacy customers to AWS, the EV shrinks. If the enterprise value drops below the total debt level, the equity is a zero. It goes to nothing. It is the difference between a house that structurally holds its value and a car that depreciates the moment you drive it. Rackspace has been depreciating for years. Private cloud revenue was down 3% in the last report. That is their core foundational business, and it is shrinking.
But public cloud was up 1%. The overall decline is stabilizing. We aren't seeing the massive double-digit revenue drops of the past few years. The patient is stabilizing on the operating table. And this baseline stability allows them the breathing room to focus on the high-margin Palantir work.
Stabilizing on the operating table is a terrifying metaphor for an investment.
Maybe. But that is exactly where the alpha is found. The market hates uncertainty, and it over-punishes distressed assets.
Let us talk about how the market is actually pricing this patient then. You mentioned the price-to-sales ratio being cheap earlier.
It is absurdly cheap. 0.2 times sales. You can very rarely buy a software-adjacent business for that kind of multiple. It implies the market thinks their recurring revenue is practically worthless.
But price to sales is a useless metric for a company with this much leverage. It completely ignores the debt side of the equation. You have to look at EV to EBITDA, enterprise value to earnings before interest, taxes, depreciation, and amortization. Rackspace is currently trading at 15.7 times EV to EBITDA. That is not cheap by any stretch of the imagination. Compare that to its direct peers in the legacy IT services space. Kyndryl trades at 3.9 times EV to EBITDA. DXC Technology trades at 2.7 times. The market is actually charging a massive premium for Rackspace relative to its actual earnings power, largely because that huge debt pile inflates the enterprise value. You are paying a high-growth multiple for a fundamentally distressed asset.
I see why you frame it that way. But comparing Rackspace to Kyndryl or DXC is looking entirely backward. Those are legacy comparisons for the old version of Rackspace. You need to account for the AI native premium. Look at a company like Nebulous. They're seeing massive valuation surges simply because they are viewed as pure AI infrastructure plays. Rackspace is maneuvering to catch this exact draft. The key to fixing that EBITDA ratio is margin expansion. Currently, Rackspace has gross margins around 19% because they're largely just reselling other people's infrastructure. But Palantir Services, Sovereign AI Consulting, that is a 30 to 40% margin business. If they can successfully shift their revenue mix toward those services, the EBITDA expands rapidly, the ratio comes down organically, and the stock re-rates.
That is a massive, massive if. You're asking a company to fundamentally change its entire economic profile while simultaneously navigating a debt minefield. And the options market entirely agrees with me on this risk. Despite this massive rally to $1.68 last week, we are seeing professional traders pricing in a decline back to 35 cents by May 2026. There is significant open interest on those out-of-the-money puts. The smart money is betting this pop fades quickly and financial reality sets back in.
The so-called smart money was also short 27% of the float at 40 cents, and they got carried out on a stretcher last week. Volatility cuts both ways. The options market is often just hedging against extreme tail risk.
That is a fair point, but it clearly indicates a lack of broader institutional faith in a sustained multi-year recovery.
Let us look at the actual path to a 5x return from here. If the stock goes from $1.70 to $8.50 over a 10-year horizon, that really only requires a modest 3 to 5% annualized growth rate and a price-to-sales expansion to just 0.6 or 0.8. We aren't asking for it to trade like NVIDIA. We are just asking for it to trade like a normal, reasonably healthy IT service provider. If they achieve that baseline normalcy, the upside is highly asymmetric. The bar for success is actually set very low right now.
Normalcy is an incredibly high bar when you are carrying $2.76 billion in debt. And just for the record, for the equity to 5x under your scenario, the enterprise value only needs to go up about 20%. That is the leverage effect working in your favor. But if the enterprise value drops just 20%, the equity is completely wiped out. That is the textbook definition of high risk. You are buying a lottery ticket, not a fractional share of a stable blue-chip company.
I accept the lottery ticket framing to a certain extent, but I argue the fundamental odds are much better than the current market implies. The partnership with Palantir validates the technology stack. Palantir is notoriously selective. They do not attach their brand to sinking ships. They clearly see the unique value in that UK sovereign cloud certification.
Palantir sees a new sales channel for their software. Let us not confuse a strategic vendor partnership with a financial bailout.
It is a channel that opens enterprise doors Rackspace simply couldn't open alone.
So, considering all of this, where do we ultimately land?
I think we land on a profound disagreement over potential versus probability.
To summarize my view, I look at this situation and I see a classic bull trap. The massive rally last week was a volume-driven event. It was a mechanical short squeeze driven by market technicals and sudden excitement over a press release. The strategic pivot to sovereign AI is genuinely promising in theory, but the massive debt load is the gravity that I believe will inevitably pull this stock back down to earth. Investors buying in at these elevated levels are effectively purchasing a call option with very high expiry risk. We have Q4 earnings coming up on February 26th. If they miss on cash flow or if the forward guidance is soft, this entire rally could evaporate instantly. I would urge extreme caution here. Do not blindly chase the green candles.
And to summarize my position, I look at the exact same data and see a company that the broader market had incorrectly priced for imminent bankruptcy, which creates the asymmetric opportunity. The Palantir deal validates the underlying technology stack because, again, Palantir does not partner with dying companies. If Rackspace hits their Q4 guidance, meaning revenue around $671 million, and non-GAAP profit around $33 million. The absolute floor is finally in. It is high risk, absolutely. I am not denying the severity of the debt profile. But the asymmetric upside, the genuine potential to 5x your investment if they simply survive and execute this pivot, is very hard to ignore for a company that is still generating positive operating cash flow.
It really comes down to this core question. Is this the beginning of a remarkable decade-long recovery story? Or is it just the final volatile spike before a massive debt restructuring? The line between those two outcomes is razor thin.
It is. And that tension is exactly what makes this such a fascinating debate to unpack. We aren't going to declare a definitive winner today. The market will undoubtedly decide that in the coming quarters.
Indeed it will. And for anyone listening and tracking this, please check the debt covenants before you check the daily stock price.
That is all the time we have for today. We will certainly be watching those earnings closely on the 26th. Stay skeptical, but stay open-minded.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.